Our next guest says the most direct route to higher profits is through higher productivity. And that means replacing expensive humans, sadly, with hardware. But here to discuss what stocks will rise on this thesis. I don't know if I like this thesis, Charlie Smith. Charlie Smith is a portfolio manager at Fort Pitt Capital. The chart we just teased before the last commercial break was Honeywell. Charlie, I mean, I like the thesis if I'm trying to make money. I don't know if I like the thesis if I'm the employee who's going to lose their gig. Walk us through the thesis and how fast you think this thesis is playing itself out. We do have a Honeywell on the screen, so maybe we should start there.
Well, good morning, Andrew. Yeah, it's been playing out steadily for 25 years, and I think the more we regulate, the more we get government involved in business, the more business recognizes that the expenses are where the people are, and particularly in manufacturing, you've got to find a way to not only beat regulation but compete. And with Honeywell, for example, they're becoming a software company. One of their business is Honeywell Intelligrated, which is a big supplier to Amazon in the automation of their distribution centers, building equipment to move goods with as little human touch as possible, so to speak, in and out of their distribution centers. And that's been their fastest growing segment now for about a year and a half.
And in terms of where you think the stock can be, let's do 12 months out. What do you think the upside is still from here?
Well, Honeywell has had a long track record the last 6 or 7 years of boosting margins, particularly in their aerospace segment. So the stock has done very, very well. So we'd be patient with Honeywell. It's a name that we could see the stock pull back 10–15%, particularly if we do get continued trade concerns.
Well, that's what I was going to say. How does that factor into your thinking?
Well, we would expect that the stocks that have held up the best, particularly in the industrial group like Honeywell, have a potential to pull back 10 or 15% if we do get a further recession scare. And if you, each of the names that we're looking at, we're looking to buy at lower prices, frankly, because the odds of recession have ticked up here in the past month or so from what we believe is maybe 1 in 10 to 2 in 10. And so we'd look to get each of the names that we're looking at today, you know, the Cognex, the Rockwell, and the Honeywell, at prices maybe 10 to 15% lower than today on a recession scare. Okay, we tend to hold names for 10 to 12 years. So we'd be happy to buy these stocks lower.
You just mentioned Rockwell Automation. Walk us through. I mean, I gather it's part of the larger thesis, but Rockwell in particular.
Well, Rockwell is really becoming a software company. They provide automation for both discrete and process, that is, individually manufactured products and sort of steady line manufacturing, whether it's steel or paper. Very nice, diverse customer list, significant exposure in China, particularly in the automotive markets, which is had been one of the fastest growing in the world, although it's pulled off here in the last 18 months. But Rockwell really is the leader in integrating software and hardware, and as I say, they're really becoming a software company with generally much higher margins. That's where the margins are in automation, is in the software.
Okay. Charlie, we appreciate it very much. We should say Cognex is another stock that you like among that thesis and that group.